There is a financial weapon sitting in plain sight that makes nuclear bombs look like firecrackers. $600 trillion in derivative contracts are stacked like dominoes across every major bank on the planet. When this house of cards collapses, and the mathematics guarantee it will, there won't be enough money in the entire world to stop the cascade. Most people have never even heard the word derivative, yet these invisible contracts control more wealth than 6 entire global economies combined. They nearly ended civilization in 2008, when they were only $60 trillion in size. Today, they are 10 times larger, held by the same banks that almost destroyed everything 17 years ago. Except now, those banks are bigger, more leveraged, and more interconnected than ever before. This is the story of the $600 trillion derivative time bomb, and why it is set to explode in 2026. Chapter 1. The Weapon of Mass Destruction. In 2003, the most successful investor in history, Warren Buffett, sat down to write his annual letter to shareholders. In it, he issued a warning that should have been screamed from the rooftops of every capital in the world. He called derivatives financial weapons of mass destruction. He wasn't being dramatic, he was being prophetic, because what we are facing in 2026 isn't just another financial crisis. It's not a simple recession. It is a mathematical certainty. It is the cold, hard arithmetic of what happens when $600 trillion in simultaneous bets go wrong. When every single government on Earth lacks the resources, the credibility, and the printing presses to bail out the losses. The Federal Reserve can't print enough money without destroying the value of the dollar. Congress can't borrow enough without collapsing the entire U.S. Treasury bond market. And the European Central Bank, the Bank of Japan, and the People's Bank of China? They're all already drowning in their own debt crises. The $29 trillion global bailout in 2008 was unprecedented. It was a Hail Mary pass that barely saved the game, but that was for a $60 trillion problem. Today, the problem is $600 trillion. The bailout capacity that saved us then simply no longer exists. This time, there is no backstop. Chapter 2. What is a derivative? The theory versus the reality. To understand why this is a civilization-ending weapon, you need to cut through the Wall Street jargon and understand what a derivative actually is. At its core, a derivative is a financial contract whose value is derived from something else. That something else can be anything: a stock price, an interest rate, a currency, the price of oil, or even the weather. The key insight is this: the derivative doesn't require you to own the underlying thing you're betting on. You can bet on Apple stock without owning a single share of Apple. You can bet on oil prices without ever taking delivery of a single barrel of oil. You can bet on whether Tesla will default on its debt without owning a single Tesla bond. Think of it like this. It's like buying insurance on your neighbor's house. You don't own the house. You have no insurable interest in it, but you just collect a massive payout if it burns down. Now, imagine that in the derivative world, 1,000 different people can all buy insurance on that same house. And when it burns down, they all expect to get paid in full. That's the moment the insurance company realizes it doesn't have nearly enough money to cover all the claims. There are 4 main types: futures, options, swaps, and forwards. They sound technical, but the concept is simple. Futures let you bet on the price of something at a future date. Options give you the right to buy or sell something at a specific price. Swaps let you exchange one type of cash flow for another, like swapping a fixed interest rate for a floating one. Forwards are custom-made futures contracts between 2 parties. Now, banks will tell you these instruments are essential for managing risk. And in their legitimate form, they are. A farmer uses futures to lock in the price of his wheat before the harvest. An airline uses them to hedge against the cost of jet fuel rising. A multinational corporation uses them to protect against currency fluctuations. This is the theory. This is what Wall Street tells Congress and the public. But this is not what the $600 trillion market looks like today. Less than 5% of it is for this kind of legitimate, real-world hedging. The other 95% is dominated by banks making massive, leveraged bets with borrowed money on the direction of interest rates, credit spreads, and currency movements. They are not hedging real business risks. They are speculating, And they are doing it with depositor funds and taxpayer guarantees. Here's where it gets terrifying. The notional value of a derivative is the total face amount of the bet. But the actual money at risk, the collateral, is usually a tiny, tiny fraction of that. When JP Morgan enters into a $100 million interest rate swap, the notional value is $100 million. But JP Morgan might only have to put up $1 million in collateral to back that bet. That is 100-to-1 leverage. If the bet moves just 1% against the bank, that $1 million in collateral is completely wiped out. If it moves 2%, the bank now owes money it doesn't have. Now, multiply that single bet by hundreds of thousands of contracts across dozens of global banks, and you have a system where small, routine market movements can trigger catastrophic, irreversible failures. The real problem isn't the size of the individual bets. It's the mind-bending complexity and the absolute interconnection of the entire web. Chapter 3, 2008, The Dress Rehearsal. This isn't a theoretical threat. We have already had a dress rehearsal. In 2008, a $60 trillion derivative market nearly vaporized the global economy. And it all hinges on one concept: counterparty risk. Let's look at the two most iconic failures: Lehman Brothers and AIG. Lehman Brothers, when it filed for bankruptcy, had over $35 trillion in derivative contracts outstanding. Think about that number, $35 trillion. From a single investment bank, every institution that had a derivative contract with Lehman, every bank, every pension fund, every insurance company suddenly faced a terrifying reality. Their insurance policy was worthless. The counterparty they relied on to make good on their bets was gone. The failure of Bank A meant it couldn't pay Bank B, so Bank B, now facing unexpected losses, couldn't pay Bank C. The failure cascaded through the network in hours, not days, freezing credit markets worldwide and threatening to stop the heart of the global economy. Then there was AIG, the insurance giant. AIG's financial products division sold something called credit default swaps. These are derivatives that act like insurance on bonds. Banks all over the world bought these swaps from AIG to protect themselves against their mortgage securities going bad. AIG collected the premiums and assumed the risk was minimal. They genuinely believed a nationwide housing crash couldn't happen in modern America. But it did. When housing prices collapsed and mortgage defaults spiked, AIG suddenly owed tens of billions of dollars it did not have. Its credit rating was downgraded, which triggered clauses in the derivatives contracts forcing AIG to post additional collateral immediately. The insurance giant couldn't come up with the cash. Within days, AIG was facing bankruptcy. But here's the kicker: the real beneficiaries of the AIG bailout weren't AIG shareholders. It was the banks that had bought the credit protection. Goldman Sachs received $12.9 billion. Merrill Lynch received $6.8 billion. Bank of America received $5.2 billion. The taxpayer bailout of AIG was essentially a covert bailout of the entire banking system. The total cost of the 2008 crisis was a staggering $29 trillion in global government commitments, bailouts, loans, guarantees, and money printing. That was nearly twice the size of the entire United States economy at the time. All of that to prevent the collapse of a derivative market that was 1/10 the size of today's. The system was saved, but barely, and the lesson was clear. Derivatives had grown too large, too complex, and too interconnected for anyone to control. The rational response would have been to ban the most dangerous types and force banks to hold real capital against their bets. So, what did the regulators do? They did the opposite. Chapter 4. The concentration problem and the illusion of safety. In the aftermath of the crisis, the banks launched the most aggressive lobbying campaign in history. They argued that derivatives were essential, that banning them would harm the economy, and they won. The Dodd-Frank Act of 2010 created some new reporting requirements, but it didn't reduce the size of the market. It didn't ban naked speculation, and it didn't fix the leverage problem. The result was as predictable as it is terrifying. The derivative market didn't shrink. It exploded, growing from $60 trillion to over $600 trillion today. And this $600 trillion time bomb isn't spread around the world. It is dangerously concentrated. Just 4 American banks now control approximately 90% of all derivative exposure in the United States. Let's look at the numbers. JP Morgan Chase holds $54 trillion in notional derivative exposure. The bank's actual equity capital is about $300 billion. This means JP Morgan's derivative book is 180 times larger than its ability to absorb losses. 180 to 1. Citibank holds $48 trillion against capital of $200 billion. Goldman Sachs holds $47 trillion against capital of just $120 billion. Bank of America holds $37 trillion against capital of $280 billion. Add it up. These 4 institutions are carrying $186 trillion in derivative exposure. That is nearly double the entire annual output of the global economy. If any one of these banks miscalculates, if any one of them faces unexpected losses, the resulting insolvency could exceed the bank's capital many, many times over. The banks will tell you this is an overstatement. They claim their net exposure after offsetting bets is much smaller, perhaps only $50 billion for JP Morgan. This sounds reassuring. Until you remember that Lehman Brothers and AIG made identical arguments right up until the moment they collapsed. Their hedges worked perfectly until they didn't. When markets become chaotic and counterparties start failing, hedges evaporate faster than morning mist. What looks like a perfectly balanced book suddenly becomes gross exposure with no protection. That's when banks discover their true risk isn't the net amount in their models, but the full, terrifying notional value of every contract they've signed. But wait, you might ask, didn't they build safeguards after 2008? They did. And they made the problem worse. They created central clearinghouses. The idea was brilliant. Have a middleman stand between every buyer and seller, guaranteeing the trade. If Bank A fails, the clearinghouse still pays Bank B. But there are 2 fatal flaws. First, clearinghouses only cover standardized derivatives. The vast majority of the $600 trillion market consists of custom, over-the-counter contracts that bypass clearing entirely. The same shadowy, interconnected web remains. Second, the clearinghouses themselves have become too big to fail. They now concentrate risk into a single point of failure. Their rules allow them to tier up contracts or demand emergency cash from their surviving members during a crisis. This means that even a conservative, well-managed bank could be driven into insolvency overnight, forced to pay for the catastrophic bets of its most reckless competitors. The system designed to save us has simply created new, more concentrated ways to fail. Chapter 5, The Modern Accelerant, 0, DTEs, and Gamma. So we have the bomb, the $600 trillion in concentrated leveraged derivatives. We have the flawed containment system, the clearinghouses that amplify risk. But what is the detonator? What could possibly set this all off? The answer is a new financial instrument that has compressed the entire market's time frame from years to literally hours. They are called 0 days to expiration options, or 0 DTEs. These are options contracts that are bought and sold and expire, all on the same day. They are incredibly cheap, which allows traders to control massive trillion-dollar notional positions with very little money. As of late 2025, they account for over 50% of all trading volume in S&P 500 options. Over $1 trillion in notional value every single day. This massive volume has created a structural fragility based on a concept called gamma. Gamma measures how violently the price of a derivative itself changes when the underlying asset moves. Because 0 DTEs are so close to expiration, their gamma is explosive, hypersensitive, on a hair trigger. Here's the doom loop this creates. 1. Massive volumes of 0 DTE options are sold, essentially making a bet that the market won't move. 2. The market makers, the institutions that provide this liquidity, must hedge their own risk. To stay neutral, they have to dynamically buy or sell S&P 500 futures. 3. If the market ticks down even slightly, say 0.5%, the gamma exposure forces these market makers to sell futures to rebalance their books. 4. This forced selling pushes the market down further. 5. The further drop triggers more gamma-induced hedging, forcing more selling. It becomes a self-reinforcing feedback loop. Liquidity doesn't just disappear, it actively turns against the market, creating a vacuum. This isn't theory. We saw it happen on December 20th, 2023. On a quiet afternoon, with no major news, the S&P 500 suddenly plummeted 1.5%. It was a gamma seizure, a tiny warning tremor of what this mechanism can do. This is why JP Morgan's own chief strategist, Macroeconomics, has repeatedly warned that the zero DTE market could amplify a normal 5% market decline into a devastating 25% single-day rout. A 25% crash in a single day, the 600 trillion derivatives bomb is waiting for a detonator. The 1 trillion daily zero DTE market is the precision wire that can short-circuit the entire system in milliseconds. Chapter 6, the 2026 detonator, triggers in play. So the bomb is armed, the detonator is in place. The final question is, what provides the spark? The spark is the convergence of multiple, undeniable triggers, all set to climax in the 2025 to 2026 window. Trigger 1, interest rate volatility. Over $500 trillion of derivatives are directly tied to interest rates. For over a decade, banks placed their bets in a world of near zero interest rates. That world is gone. The Federal Reserve raised rates from 0% to over 5% in just 18 months, the fastest hiking cycle in 40 years. This has already created massive, hidden losses on bank balance sheets. The failures of Silicon Valley Bank, Signature Bank, and First Republic in 2023 were not the crisis itself. They were just the first tremors, the warning shots. Banks are currently allowed to hide these losses through accounting tricks. They are sitting on their balance sheets right now like unexploded ordnance, waiting for the next shock. Trigger 2, the commercial real estate maturity wall. Over $2 trillion in commercial mortgages must be refinanced between now and 2026. These properties were originally financed when interest rates were 3%. They must now be refinanced when rates are 7, 8, or even 9%. This math doesn't work. Widespread defaults are not a possibility. They are a mathematical certainty. This will trigger massive losses on the banks that hold these loans, and it will activate the credit default swaps written against them, creating another AIG-style crisis. Trigger 3, European bank instability. We already saw Credit Suisse collapse and be absorbed by UBS in 2023. Deutsche Bank, which holds over $40 trillion in derivatives, perpetually teeters on the brink. The failure of a major European bank would instantly transmit losses back to the American giants through the derivative web. This is a global system. Trigger 4, sovereign debt crises. Japan has a debt-to-GDP ratio of 260%. China is drowning in over $13 trillion of local government debt and a collapsing real estate bubble. A loss of confidence in the debt of a major nation would cause a tsunami across the interest rate and currency derivative markets, which are all interconnected. Any one of these triggers could be enough. But in 2026, they are all converging simultaneously. The AI bubble crash we've discussed in previous videos will provide the initial volatility shock. The zero DTE market will amplify it, and the commercial real estate and sovereign debt crises will ensure the fire cannot be put out. Chapter 7, the ultimate betrayal, the bail-in. The outcome of this crisis will not be a simple stock market crash that you can wait out. It will be a systemic failure that threatens the very core of the banking system. In 2008, the government's answer was the bailout. They used taxpayer money to save the banks from their own mistakes. But after the public outrage, a new law was quietly put into place to prevent another politically toxic bailout. The new rule is called the bail-in. This is the ultimate betrayal. A bail-in allows a failing, insolvent bank to recapitalize itself by converting its liabilities into equity. What are its liabilities? Its debts. And what is one of the biggest debts a bank has? Your deposits. That's right. Under a bail-in regime, the uninsured portion of your bank account, any money you have over the FDIC insurance limit of $250,000, can be legally converted from cash into shares of the now failed bank. Your liquid savings, your emergency fund, your down payment for a house, could be turned into worthless stock in a bankrupt institution overnight. The goal of post-2008 legislation was to end too big to fail. Its true effect was to ensure that in the next crisis, the cost would be borne not by the taxpayer, but by the bank's own customers. When the $600 trillion derivative bomb detonates and a major bank is deemed insolvent, these bail-in rules will kick in. It is the law. Now that you understand the threat, the critical question is, how do you protect yourself? The strategies are not what you might think. And in an upcoming video, we will provide a detailed playbook on insulating your wealth from a bail-in. The only way to ensure you see that video is to subscribe and turn on notifications. Don't be caught unprepared. Conclusion. The derivative time bomb is not a matter of if, but when. The triggers are already firing. The mathematics are undeniable. The bailout capacity is gone. When this weapon of financial mass destruction detonates in 2026, it will make every previous crisis, 2008, 1929, the Great Depression, look like a practice round. The smart money is not debating if this will happen. They are moving now to protect themselves. This is not fear-mongering. This is financial preparedness. The patterns are clear, and this channel exists to help you see them. If you want to stay ahead of what happens next, to turn complexity into clarity, then you need to subscribe and tap the bell, because when the dominoes start to fall, the news will be too late. The question for you is not whether you believe this will happen. The question is whether you will be prepared when it does.